So let's look at what we dealt with in the last class. So what was it that we dealt with in the last class? We took NPV. That's what we did. And we dealt with how do we incorporate inflation? How do we deal with taxation? And if there's a cash flow code working capital, how do we deal with this? I'm sure you all remember very well that these are the items that we illustrated in the last class on how to deal with them. And I'm very sure that you have an idea of how or what is involved in dealing with these items. Why we need to capture them, but also how we do so. I'm sure that is something that you must have picked from the last class, huh? Yeah. So now, today we have a question, and in this question, these items will come up again. And all I want to see is how do you deal with these items? So these items will come up again. So let us run through our question. We call our company today T. So we're going to call our company T. So T company plans to buy a new machine. So there's a project proposal here. To meet expected demand for a new product, this product is called product T. This machine will cost us $350,000 and will last for 4 years. Now, these are the facts that we need if you're going to do an NPV. We need to know what is the proposed capital expenditure. What is the proposed capex? That must be there. And also the time frame. The time frame. Over how many years are you going to appraise this project? Over how many years are you going to appraise this project? And also, is there a disposal proceed at the end? So at the end of which time it will be sold for $20,000. T company expects demand for product T to be as follows. So these are the units. And these are some of the variables that you are going to come across again and again. Most of the investment projects involve making a product that would have to be sold in stated volumes. The selling price for product T is $12. The variable cost is 7.8, and the incremental annual fixed production overhead is 25,000 per year. Now look at the language of inflation here. We are told that the selling price, the costs are all in current price terms. So what is the meaning of that? What is the meaning of that? Well, the meaning is that inflation has not been captured. In other words, if all these things took place today, that's what we expect. So that's the expression current price terms. So we are saying we're not using the future prices, we're using the prices today. And what we learned was that, of course, we're looking at this point in time. So there's year 1, year 2, year 3, and year 4. And the prices that we have today, for instance, the variable costs of 7.8, this cost will not continue at 7.8 over the project life. No, it can't continue that way. We expect that the price is going to, or the prices are going to change. And that is where the issue of inflation comes in. How do we factor in inflation? Okay. The selling price and costs are expected to increase by inflation every year as follows. So now you're given the inflation figures for the selling price is 3%, for the variable cost is 4%, for the fixed costs it's 6%. Yeah, so these are the inflation rates every year. So the question is really preparing us to deal with the items that we discuss in class. Vis-a-vis, which item is that one? The item that we're talking about here is inflation. So you've seen enough language to enable you figure out what you're going to do about inflation. Let us continue with our analysis. Continue with our analysis. Additional information goes as follows. T has a real cost of capital of 5.7. Now, in the last class, we discussed, what does this mean, real cost of capital? Who remembers the real cost of capital? What type of a cost of capital is this one? Who remembers that? Who remembers that? If the cost of capital is described as real, what does it mean? It means that it's not inflated and pays tax at an annual rate of 20%, 1 year in arrears. So the tax for year 1 is paid in year 2. That's the meaning of that. It can claim capital allowances. Remember, capital allowance is a relief which a taxman will give you. On 25%, what format? Reducing balance. So we have enough information again to help us deal with that. We have enough information to help us deal with taxation. The tax aspect has come through. Working capital amounting to 15% of sales is required at the start of each year to support the operations and is recoverable at the end. So they have given us enough information on working capital. How to calculate it? The information has been given. And also, what happens at the end of the project? We are told what should happen to the working capital. The company has a target return on capital employed of 20%. Depreciation is charged on straight line. That of an asset. Required, calculate the NPV, calculate the internal rate of return, calculate the discount in favor, calculate the accounting rate of return. So we have got a fully packed question here, which will enable us deal with the items that we dealt with in class. The issue of taxation will come out in this question. The issue of inflation will come out in this question. The issue of working capital will come out in this question. So you've got all this. Okay. So what we do now is we are going to cut these requirements into Excel, and then we start putting down the figures there. Okay. So please, I invite all of you to get ready with your working papers, with your pencils, with your pens. Some of you open the spreadsheet itself so that we get started. Okay. The best question is the best way to approach this question is to use a table. So table method works very well. It works wonders. And it enables us to deal with the figures in a better way, in a more organized way, and a way that we can follow. So we start with the selling price. The selling price, they say, as at today, is 12. Using today's prices is 12 the unit. But investment appraisal, we assume that the cash flows occur at the end of the year. The cash flows occur at the end of the year. That is the assumption that we make. So all the cash flows that happen, all the revenues that happen between year 0 and year 1, we assume that they all take place 1 year from now. So anything that happens in between here, in investment appraisal, we say, take it that it all happened at once at the end of the year. Similarly, when in year 2, there will be transactions taking place every day during the year. But we say, assume that actually there was one lump sum, one lump, a single lump of all these at the end of the year. So what we do is we take our selling prices and we say, what will it be at the end of the year? Now, some of you may have a question for me. The question that you may have is, in class, we covered 2 methods of dealing with inflation. Do you remember that? Remember what we said?
Yes.
We said there are 2 methods. What are those 2 methods?
We inflate the cash flows or ignore inflation.
Yes, so the possibility is to inflate all cash flows. Okay, so that is one possibility that is there. We can inflate all the cash flows. Or we can actually ignore inflation. So which one are we going to follow in this case? Are we going to go for 1 or 2? Which one are we going to follow? What is a guide? We gave a guide. What guide did we give?
They use the real rate.
So the guide that we gave is you follow the company policy. What does the company do? That is number 1. Number 2, where elements are inflating at different rates. The selling price is at a different rate. The variable cost at a different rate. The fixed overhead is at a different rate. If there's a different inflation rate for each one of these, what did we learn? What approach should you follow? What approach should we follow? Where cash flows are inflating at different rates. Like here, we have seen that this one is at 3%. This one is at 4%. This one is at 6%. What is the correct approach to use? Can somebody help us?
Are we not supposed to inflate the different variables using the different rates that have been given?
Yeah, so the correct approach is when items are inflating at different rates, the correct approach is to inflate all the cash flows. And once you inflate the cash flows, then what discount rate are you supposed to use?
The money rate.
So have you seen what was expected in this question? So in this question,
Yes.
because of the different inflation rates used, the approach that was expected from you was the first one, to inflate all the cash flows. Have you seen how I've arrived at the decision? So we're going to inflate our cash flows. So let's start inflating the cash flows. Let's start inflating our cash flows. Let's start the selling price. Let's start with the selling price. Let's start the selling price. Before inflation, our selling price was what? Or in year zero. In year zero here, the selling price was $12. We're now inflating. So you say the first sale we're going to make, or all the revenues are going to come 1 year from now here. So that's where we have the first revenue. So what will be the price 1 year from now? It's 12 multiplied by 1.03. You get the answer. So what is the answer there?
12.36.
12.36. So 12.36 is your answer. Again, you multiply by the same 1.03. What do you get?
$12.7.
4.73. So you continue multiplying by 1.03. You continue multiplying by 1.03. So these figures now, there's that, and that. Is that okay? So that is how we get our selling prices over the next 4 years. What are variable costs? Variable costs, it was 7.8 before inflation. Then you inflate by 1.04. What do we find?
8.11.
8.112
112.
or 8.11. So we take this one again, 1.04. You get the answer. So we keep on multiplying by 1.04. So this is how we inflate the selling price and the variable cost. Then you can calculate the contribution here. How do you calculate the contribution? The contribution is simply our selling price less the variable cost. And that's what we have. Multiply by the number of units. I've dropped 3 zeros. Multiply by the units. we have the total contributions. We have our total contribution. Then from there, we have fixed cost. The fixed cost figure is 25,000. This was as at today's prices. This is as at today's prices. So then we inflate the figures using 6%. So we take 25, the first one is 25. Throw the 3 zeros, multiply by 1.06. You round off your answers. So what do you get when you get 25 multiplied by 1.06? What do we get?
$23.58.
20?
23.58.
23.58.
No, we actually get 27.
27. This is 25, eh? You're multiplying by 1.06.
It's 20.5 rounding off 27.
26.5, sorry.
Okay. So these are our fixed costs here. You continue to multiply by 1.06. Remember, we have dropped 3 zeros, eh? That's how our numbers are small. Okay. So up to this point then, what do you get? What do you call the terminology? Because you define the figures that you found. What we found is the taxable cash flow, or a cash flow before tax. So this question is almost done, friends. It's almost done. So all you come now, you say, okay, we are paying tax at 20%. So you take this figure, multiply by 20% to find the tax that you are going to pay. And you find that is 24. Now this is the tax you're paying. When I'm paying it, yes, the incomes arose in year 1, but our tax is paid in arrears. So that tax is paid here. That is why this 20% of that figure is not put here, no, it's put in the following year. And you continue with the same pattern after that. So that is the issue of tax. Inflation, you have seen it. And also one part of taxation. Now we say that the taxman is going to give you capital allowances in recognition of the fact that you have spent huge amounts of money on the acquisition of the asset. So it needs to give you a relief. And the relief that it gives you is what we call the capital allowance. So we need to calculate the capital allowance, and then after you find the capital allowance, what are we going to do? We'll get a tax relief. So let us now go and calculate the capital allowances. So that's the first step that you're going to do. Let's calculate capital allowances. They have given us information about capital allowances. What information did they give us about capital allowance? They told us that is 25% reducing balance. So that information has been given to us. Reducing balance. So that's the method that you need to use. So whenever you're going to work on your capital allowance, you need to ask yourself, what is the method? Because some questions will say, take it straight line. it's also possible to do a straight line. So a straight line is possible. But this one says use a reducing balance. The asset cost us 350. So when the taxman comes, here's what they will do. They'll look at first year. This was your expenditure. So they'll calculate 25% of that. Please, can you take our calculators and let's calculate 350 multiplied by 25%. What are we getting?
87.5.
Yes.
87.5.
Yeah, so you round it off, fine. So that 87.5, you round off. So that's the capital allowance that will be given. In the following year, they will say 350 minus 88, 263. You get 20% of that. Again, you get 10% of that. Not 20%, 25%. Capital allowance is at 25%. What of in the final year? In the final year, after we have taken out the capital allowance for year 3, so as year 4 starts, this is the written down value. So what do? We take this figure and apply, and we do not apply the 25%. In the final year, we calculate a balancing allowance or a balancing charge. Two things that will happen. How? We take 148, we subtract the disposal proceed, the 20, we subtract. So 148 is what has not been claimed there. This has not been claimed. So you take out how much you cover from the sale and you arrive with a value of 128. This 128 is not the capital allowance. We call it a balancing allowance. So this is 128 balancing allowance. Now, after you calculate the capital allowances, going by the method that we use, what do? You calculate the tax saved at 20%. So you take this figure, multiply by 20%. You take that figure, multiply by 20%. You take that figure, multiply by 20%. You take this figure, multiply by 20%. And this is now what we call the tax that will have been saved. These are tax savings. These are tax savings. That's a tax that will be saving every year. Why? Because of the relief. So the relief reduces the tax that you're going to pay. And that amount is a benefit. That amount is a saving. That amount, we capture it as a saving. That's why we say tax saved on the capital allowances. So these are the figures that you pick. So bring them here now. The benefits also will be received in arrears. The benefits will also be received in arrears. Is that okay? So that is why at the time when you go and make the payment, that's the time when your relief will be given to you. So if you notice, then we have dealt with tax. Tax that is payable on the taxable cash flows, The tax that is saved on the capital allowances. We now get to the last one, which is the working capital. Working capital. We've been told the formula for working capital. Let's say working capital is 15% of sales. So before we can trade in year one, we need working capital, which is 15% of sales. %15 of sales. So where are the sales figures? Where are the sales figures? The sales figures are here. We get the selling price multiplied by the number of units. The selling price multiplied by the number of units. The selling price multiplied by the number of units. The selling price multiplied by the number of units. So when you multiply the selling prices by units, what do you get? You get the sales revenues. And working capital is normally linked. Working capital is a proportion of sales. This time around is 15%. This time around, we are told that apply 15%. So let's apply the 15%. So here we are. Our sales revenues, selling price multiplied by the volumes are here. Before you can generate these sales in this year, in this period of time, you need working capital of 65, which is that multiplied by 15%. That is how I calculate working capital. So when you do the multiplication, what do you find? 433 multiplied by 60. Let's go, let's share. 15% multiplied by 433. What do you find? 433 multiplied by 15%. What do we find?
64.95.
Yes, rounded off. 65. Now, this working capital of 65, when should we spend? This working capital is needed to generate these sales. So before we can generate these sales, in year 0, we must have this figure. In the subsequent years, what happens? Just the increase is recognized. So here, we'll get to the increase. We inject it. There, another increase. There, there's a reduction. This reduction will be captured as an inflow. That will be an inflow. Remember, when there's an increase, it's a what? It's an outflow. A decrease is an inflow. At the end, what do we do at the end? They say all the amounts still sitting in working capital will be recovered. So what do we cover? There's an outflow. So you add this outflow, you add this outflow, you add this outflow, then you subtract this inflow. You must be able to come to that answer. That is the amount of money which is sitting in our working capital. How are you getting the 51? I'm waiting for confirmation. I'm waiting for confirmations. $65 plus 11 plus 22, knock off 48. Are we getting 51?
I'm getting a 50.
You're getting a 50. Yeah,
It would be issues of rounding.
that's a rounding of error because I'm using a spreadsheet which does not round it off. Doesn't round off, it captures all the figures. Okay. Let's go back to our table. So your working capital figures are recorded here. The working capital figures are now recorded here. That one, that one. That one, the inflow and the recovery. We are now done with all the cash flows. The asset, cash outflow, and the what we expect there. Now let's deal with one more last item here. Let's deal with an item here. Here we are. Let's do with an item. We have inflated all our cash flows. So what are we looking for? When it comes to discount rate, we are looking for a nominal rate. That's what we're looking for. But this particular question, what have they given us? What have they given us? Real rate. So this real rate, you need to convert it into money rate using the general inflation rate of 5%. Now remember, 1 plus what? Money rate equals 1 plus real rate multiplied by 1 plus inflation rate. So 1 plus the money rate, let's go, equals 1 plus the real rate multiplied by what is the answer there? Can somebody please give us the answer there?
$1.109.
Like that?
Yes.
Okay. We take this one on this side. What do we have?
0.1098.
Multiplied by 10%, multiplied by 100%.
10.9, 11%.
Rounded off 11%. So this is the appropriate discount rate that we are going to use. That is the appropriate discount rate that we are going to use. Are you together, people? That's the appropriate discount rate to be used. I hope you have seen how we have moved from the real rate to the money rate. If that is okay, we can now go back here and conclude our work. We come here. So at 11%, so we come to 11%. So let's discount at 11%. So now we know that we must discount at 11%. That is 1. This one divided by, okay, there we are. So we go. Then we start discounting that by that. Then we come there. Let's round off our answers. There we are. We found our NPV, net present value, which is positive. And the decision will be, we must go ahead with this project. The decision is go ahead with the project. That's a decision. Go ahead with the project. Why? Because your NPV is positive. So therefore, what have we covered in this question? We have seen how to deal with inflation. We have seen how to deal with taxation. We have seen how to deal with working capital. So that's what we have seen today. So what do we want you to do? I want you now, as you study, to calculate the internal rate of return. I want you to calculate the internal rate of return. I want you to calculate the discounted payback and accounting rate of return using these figures that we have. When we come on Friday, we'll conclude this question. But on your own, please try to calculate the internal rate of return, discounted payback, and accounting rate of return. Okay. That's what we'll do in our next class. Yes, Bertram.
Yes, sir. I've got a question on the reducing balance method,
Yes.
yes, I have, and I know I've understood how to calculate the reducing balance method. What about in the situation where they say that you use the straight line method? Is there any situation like that?
Yes, they can tell you that use a straight line method. In which case, what you do is Bertram, you say the 350 minus the 20 at the end divided by the 4 years. That's what you do.
Okay.
And the figure that you find, to find the tax saving, you still multiply by the 20%. So yes, it's possible.
Okay. And the other question is, I know I noticed on the fixed cost we needed to inflate them.
Yes.
But what about in whereby you're not given the inflation rate? What are you supposed to do?
If there's no
Are
inflation
you
rate,
supposed
then it means maybe the figures are inflated already for you. It could
so
be
many?
it means the figure has already been inflated for us.
You know, thanks a lot, sir.
Cheers. Thank you, Bertram. It's nice to ask questions. Okay. Is there another question? Well, this
Yeah,
is
maybe just a follow-up on what the other colleague is from asking.
yeah.
In the same vein, if the figures are inflated, there is a situation where we could be asked to deflate the figures to use the real cost of the real rate.
No. If the figures are inflated already, the best to do is to just get the money rate.
No, okay.
Just use the money rate. These are nice questions, but you can be asked a question where they can ask you to do both. Inflate the figures, and number two, don't inflate the figures. That is also a possibility. And I'm going to expose you to enough questions so that you come across these situations that you have on your minds.
Okay, and just a follow-up before you go. Since Thursday is a holiday, I don't know if it's still, if you could take advantage of bringing the Friday one to Thursday, the lesson. I don't know what the program is. It's still packed for Thursday.
Okay. They say Friday is a holiday, but when is the holiday?
Thursday.
Well, Thursday is a holiday. Okay. So there's a proposal there that we can do our class on Thursday. Thursday, it will be in and out in the afternoon, because in the mornings, I think I've got some classes that I'll be doing. There's a proposal that
other colleagues.
colleagues. Okay,
This is okay for me.
Okay, so what we do is, if there's anyone who has got an objection for Thursday, please post on the forum.
Okay.
If anyone has got an objection for Thursday, put on the forum. If you have no objections, then I'll just advise on the time that we do it in the afternoon.
Okay.
Naturally, you can do a lot more work. You can take a long session to finish off this question and do another one. We can finish off this question and we can do another one of a similar type.
Okay.
All right.
Thank you.
Thank you very much. Yes, please.
Just a quick one. On the working capital that what we did calculate down here.
Yeah.
I know there are some questions which I've seen where they don't bring this component. How often does this component come in the exam? Because I've just noticed that this component somewhere, so I kept it somewhere where they have to calculate the what this working capital, then you add it whatever, I don't know. And what and why are they looking like you're paying them in year, is it year 0, 1, just like that? Me, I'm trying to understand. I'm not clear this one.
Okay.